The US dollar slammed as Trump tariffs sparked massive outflows from the United States on economic fears, with key US CPI data critical this week for really shaping up further dollar movements. How is it going to react, guys? Ken Chigbo back with another E8's market fundamental update. Let's jump straight into this. So, guys, wow, that was an eventful week last week, to say the least. Massive volatility. And what did I say? There was going to be fireworks without a shadow of a doubt. And we saw exactly that aggressive movements. And, as I noted in that previous video, I said, in my opinion, I couldn't see any bullish scenario for the dollar as such. Okay. Why? Because it goes back to that narrative we were talking about before about regardless of these tariffs, right? The United States are pretty much targeting everybody. Okay. They're targeting everybody and it leaves them vulnerable. It's not just about the other country that the tariff's been slapped on. It's about the US. It doesn't just harm that country, it also harms the United States. Now think about that, them doing that to every one of their major trading partners, how crippling that is for US businesses, how crippling that's going to be for US consumers, with inflation likely to be sparked largely on the back of this. Retaliation, so much uncertainty. And you got to think from a big investor perspective, right? You've got a lot of cash. You want the most stable and sound place to invest your money. But with these tariffs, it doesn't really create that sound environment right now. In terms of short, medium term, there is a lot of worry there as to implications it's going to have on the US economy. So that's why it's prompted, and that narrative that I've been speaking about for a while about Trump making the US effectively uninvestable. We've had massive outflows from the United States and inflows into other places, right? The investors taking their money out. They're like, I just don't want this risk right now. I want to go and park my cash somewhere else. So that's why we've seen those outflows. So as I said in that previous video, the previous rundown, the US dollar, I just couldn't see a scenario where it came out bullish. And as you can see, obviously, that was some heavy, heavy downside pressure that we saw here. We smashed through that psychological key support zone once again at that mid 103 region, 103.50. Big stops being triggered to the downside without a shadow of doubt. And obviously, you can see where we want to go. Markets are just keen to tackle that next zone, which is that psychological 150 area. Now, with that being said, obviously, let's just quickly just take a look at euro, because obviously euro makes up over 50% weighting in the Dixie. And then we're going to look at the dollar fundamentals. But euro, obviously, big push to the upside there. You got to remember as well, euro is almost seen as a bit of a safe haven outside of the traditional dollars, the yens, the Swiss franc. Euro is also seen as a safe haven because the ECB is always, guaranteed that they're going to protect the euro, they're going to protect the eurozone, they'll do all that's necessary to keep it stable. So historically, they have that. It has that outside of as I say, the traditional safe havens, it has that status as well, that it's a decent place to put your money. Obviously, we had that 500 billion euros of stimulus from Germany as well. So euros was obviously very much on the receiving end of that dollar downside, and big bullish weekly candle there. And you can see where we extended into in that sort of 111.50 area, which I noted was the next major target zone. And we've left this wick potentially to the upside. And you could almost see here as well, when you look, a bit of an inverse head and shoulders, a bit of a big one, left shoulder here, head, right shoulder, and we had a breakout. Now we've got retested this neckline, subject to some further potential buying momentum. Now this week, in terms of the United States, ignore the FOMC meeting minutes, it's dated. Markets are really going to be focused on the next actual FOMC rate decision, not these meeting minutes now that haven't taken into consideration the latest tariff. So it's going to be very interesting to see their focus there. Obviously, US CPI is a big one. The month-on-month expected to remain sticky, but the year-on-year, you can see it's expected to cool down to 2.6%. Now, if inflation does cool, markets are going to further ramp up their rate cut bets, okay? There's going to be more rate cut pricing expected to cool down there. We have seen a general cooling in the economy anyway, so I wouldn't be surprised that number does cool, potentially greater than expected. Labor market has been softening. Obviously, if you look at the latest non-farm payrolls reading that we had last week, a decent amount of jobs added, but the previous revised sharply lower down to 117,000 from 151. And obviously the number has been cooling for the past couple of months now. Unemployment rate ticking higher to 4.2%. The average earnings wages, this is also deflationary. Obviously it remained in line with expectations, but the previous revised down to 0.2%. So this is all pushing into the narrative, feeding the narrative that potential slowdown in the economy, cooling in the economy. So I wouldn't be surprised if we do get a cooling in these CPI numbers this week from the United States. So the dollar does still, in this latest week, in my opinion, still looks vulnerable to potentially filling that wick and heading, making its way closer towards that next major target zone, which is down at 150. Obviously, that's my opinion. Obviously, we trade what we see. Fundamentals, especially more than ever right now, are volatile and changing a lot. So we have to remain nimble, have to remain agile, keep our finger on the pulse. But that's my view there for dollar this week. Next up, we have the RBNZ rate decision, where the central bank here are expected to cut by 25 basis points, taking the base rate down to 3.5% from 3.75%. Now, these guys have been one of the most dovish central banks outside of Bank of Canada. They're the next most dovish. They've been cutting quite consistently and quite aggressively. We had various 50 basis point cuts. These guys, it's a double whammy, those tariffs, because obviously they're exposed to China as well. You got to remember. Okay, it's not just the global economic slowdown as a result of these tariffs. It's also the fact that China is their biggest two-way trading partner. So if we have a slowdown in China, you got to remember, a massive consumer of commodities. And what is New Zealand? It's a commodity exporter. You know, they export large amounts of dairy. China are one of the largest commodity consumer in the world, importing of oil, of commodities, and commodity linked currencies get hit hard. So New Zealand is going to be hit like a double whammy on the back of these tariffs so far. And you can see, like on Friday and late last week, we had massive selling with all sort of NZD related pairs. You know, look at NZD yen down chunky amounts. Look at this week with GBP NZD, big push there. Look at Euro NZD, big push to the upside. Okay, there have been some great opportunities to capitalize on this downside. As I say, if you've sort of got your finger on the pulse with these macros and understand, like, for me, I was well positioned. I understood if China going to get these big tariffs, which they're likely to. Okay, that's going to hit AUD, that's going to hit NZD hard because these guys are heavily exposed to China. So anyway, my point is that we're expecting a dovish RBNZ, that cut, and I expected a dovish tone given the latest tariff announcements and given the uncertainty for New Zealand domestically, but also on a global level as well. It really hits them hard. And bear in mind, they're a commodity linked currency and they're a riskier currency. So there is a lot of vulnerability, in my opinion. We've broken out of this big flag. We were in this channel for a while. I remember we were watching this. And now we're exposed to further downside. And really, guys, if we go to the monthly, right, once we clear this area here, there's some demand here where we're at around the mid 55 region, sorry, the next major zone. Then we'll be looking at wick fill of these lows of the pandemic. Okay. And that could be seen very quickly into that mid sort of 54 region. So further downside eyed here with the RBNZ expected to be dovish at this decision this week. And volatility expected for GBP because we've got key UK GDP data on Friday, where GDP for the UK has been a bit of a hit and miss. Okay, we've had bits of growth, but we've been more so next to no growth at the moment. There are worries about potential stagflation. You're hearing this a lot from me, stagflation scenario in the UK because prices are still sticky, right? Inflation's still relatively high. GDP's been slow. Obviously, if you look here, a lot of missing there in these previous numbers. But the thing is, the Bank of England, the central bank, they've been on hold with rates, and they're on hold for a while. And the reason for that is because inflation's sticky. They want to bring down, they're really focused on bringing down inflation. They are concerned about growth, but their focal point is to bring down those sticky prices. And how do we do that? We keep interest rates higher in order to cool inflation. Now, when we look at GBP dollar, obviously in the weekly, we had a massive push to the upside. You know, we wicked into 132. That's a massive move for GBP, but we obviously had some pullback, just profit taking. Really, for me, I don't see that as a massive, and then obviously being sensitive to the risk off tone. But structurally right now, when we look at this, we're still very much bullish. Obviously, when you look at the monthly, incredibly bullish there. In March and in February, obviously we've had that pullback right now, but we broke out of this flag, right? We had a big breakout there. Now we've got a bit of retest, but structurally, look at this and look at this supporting, obviously, trend line that's been in place since the commence of this year is very strong. Okay, look at that. That is a valid trend line. I haven't just pulled that out of nowhere. You can see that. All these various taps. This is a massive area. And really from here, given how strong this is from the start of this year and given the vulnerability still with the dollar and the uncertainty there, you'd expect this to bounce and carry on its path to the upside. And potentially when you look, the next major zone, if we conquer this area of supply here, you know, we had a pullback here before in August 2024. We had a pullback all the way back down to 130. Obviously we're sub 130 now at 129, and then we had that big push into 134. There's no reason as to why we can't see it from this current area now and work our way into that 134 region, but we need this GDP number to be better. Okay, we need that GDP number not to be coming in contraction. We need it to beat expectations or at least be in line. But that's all the way on Friday. Obviously, up until then, it's all about dollar, and dollar does remain vulnerable, as I said in my previous video. So outside of those key events, it's also just worth noting Bank of Japan Governor Ueda speaking. Obviously, markets trying to ramp up rate hike bets. They're worried because of the potentially slowing down because of the Japanese tariffs as well. But we'll very markets are going to be clinging on to all the language, the words from Ueda. So let's keep an eye on that. But other than that, another busy week and a week filled with volatility, I'm sure. Have an amazing and blessed one, and I'll catch you on the next video.